If you're still trusting banks with your life savings, stop everything you're doing and pay close attention. The warnings we're about to share come directly from billionaire investors, Wall Street strategists, and top real estate experts. Millions of Americans are unknowingly standing on the edge of financial disaster, and the worst part is that many don't even realize what's coming. Thousands of U.S. banks are teetering on the edge of collapse, facing an unprecedented wave of distress that could wipe out depositor savings accounts in 2025. Barry Sternlicht, CEO of the $5 billion Starwood Capital Group, recently warned that the U.S. banking system is on the brink of systemic failure. Sternlicht cited higher interest rates, inflation, and skyrocketing commercial real estate defaults as the perfect storm for disaster. The distress in the commercial real estate market is especially alarming. Since 2020, the rise of remote work has left office buildings vacant and unprofitable. This trend, combined with Federal Reserve interest rate hikes since 2022, has driven borrowing costs through the roof. Many property developers are defaulting on loans, leaving banks with trillions of dollars in distressed commercial real estate loans. As of today, U.S. banks hold $1.9 trillion in commercial real estate loans, a ticking time bomb. But here's the shocking part. Depositors like you and me could soon find out the hard way that our savings aren't as secure as we've been led to believe. Sternlicht warns that despite FDIC protections, the sheer scale of potential bank failures could overwhelm the system, leaving millions unable to access their money. Like, share, and subscribe to Economy Explorer now to stay informed. And don't skip any part of this video. Donald Trump's tariffs and their role in this crisis. Donald Trump's return to the presidency has reignited his controversial tariff policies, which are adding fuel to this financial fire. His tariffs on imported goods, particularly from China, have significantly raised the cost of doing business across multiple industries. While the intention behind these tariffs was to bolster domestic manufacturing and protect American jobs, the ripple effects have strained the broader economy in unexpected ways. Businesses, especially those relying on imported goods, have faced rising input costs, which they are either unable to pass on to consumers or have done so at the risk of reduced demand. For the commercial real estate sector, the impact has been particularly severe. Tariffs on construction materials, such as steel and aluminum, have sharply increased the cost of new projects and renovations. This has made it even harder for developers to stay afloat in an already challenging environment dominated by declining property values and rising borrowing costs. Many developers, unable to absorb these additional costs, have defaulted on their loans, sending shockwaves through the banking sector. Regional and community banks, heavily exposed to commercial real estate loans, are bearing the brunt of these defaults, further destabilizing an already fragile financial system. Moreover, Trump's economic protectionism has also contributed to trade tensions with major partners, leading to retaliatory measures that have affected U.S. exports. This has added to the financial pressure on businesses dependent on international markets. The combination of these tariffs, coupled with rising inflation and Federal Reserve interest rate hikes, has created a dangerous cocktail of economic stress. Banks, already grappling with the fallout of loan defaults, now face additional risks from the broader economic slowdown exacerbated by these policies. While Trump's tariffs were aimed at revitalizing American industries, the unintended consequences have revealed vulnerabilities in sectors that form the backbone of the U.S. economy. The strain on commercial real estate and the banking sector is a stark reminder that even well-intentioned policies can have far-reaching and sometimes destabilizing effects when applied to a complex, interconnected global economy. A growing crisis in banking. The banking sector is facing a crisis unlike anything seen in recent history. According to CBS professor Tomasz Piskorski, nearly 14% of all commercial real estate loans and a staggering 44% of office loans are currently in negative equity as of November 2024. This means property values have plummeted below the outstanding loan balances, placing significant strain on banks' financial stability. Many property owners are struggling to refinance their loans due to sharply rising interest rates. Since the Federal Reserve began aggressively hiking rates in 2022, the cost of debt has effectively doubled, creating severe refinancing challenges for roughly 1/3 of all commercial real estate loans. This crisis is not confined to smaller community banks or specific regions. It's systemic. Regulatory data reveals that 70% of the top 100 U.S. banks hold commercial real estate portfolios that exceed 300% of their total equity. Smaller banks, which often serve as pillars of local economies, are even more vulnerable. Their exposure to commercial real estate debt is disproportionately high, leaving them unable to absorb losses. As these smaller institutions teeter on the edge of collapse, fears of depositor runs are escalating. Customers, worried about the security of their deposits, may rush to withdraw their funds en masse, further destabilizing the banking system. The cascading effects of this crisis are already visible. Plummeting commercial real estate values have forced property owners to sell at massive discounts, in some cases losing more than 50% of the original value. For banks, these losses mean eroded capital reserves, leading to diminished lending capacity and reduced confidence among investors. In an effort to cover mounting losses, some banks have resorted to selling off their higher quality assets, inadvertently depleting the very resources they need to survive. This cycle is particularly devastating for regional banks, which play a critical role in funding local businesses and infrastructure projects. Adding another layer of complexity is the interplay between declining commercial real estate values and the broader economy. The Federal Reserve's rate hikes, while aimed at controlling inflation, have reduced the market value of other critical bank assets, such as government bonds. This dual pressure from loan defaults and shrinking asset values is pushing many banks, even large national institutions, closer to insolvency. For smaller banks with limited equity buffers, the risks are even higher, with closures or forced consolidations becoming increasingly likely. The potential consequences of a banking meltdown are far-reaching. A weakened banking system could stifle economic growth by restricting access to credit for individuals and businesses. Industries reliant on loans, such as construction and small business operations, would suffer disproportionately. If the current trajectory continues unchecked, the United States could face a financial crisis more severe than the Great Recession of 2008. The systemic risk to the entire economy is growing, and decisive action is required to mitigate the fallout. This growing crisis underscores the importance of staying informed and proactive. Whether it's understanding the risks to your financial institution or exploring strategies to safeguard your savings, awareness is the first step toward navigating these turbulent times. The clock is ticking, and the need for vigilance has never been greater. Protect yourself before it's too late. Financial experts are urging Americans to act immediately to safeguard their finances against an increasingly volatile banking system. One of the most effective strategies is building a personal cash reserve, ensuring you have access to liquid funds in the event of a crisis. History has shown that those who act early during financial downturns are better positioned to weather the storm and recover quickly. The Federal Reserve's aggressive tightening of monetary policy has raised interest rates to levels not seen in decades, while Trump's tariff policies have exacerbated inflation and disrupted supply chains. This combination has created a perfect storm for economic instability, significantly increasing the likelihood of widespread bank failures as we approach 2025. Banks, whether small community institutions or large national players, are grappling with loan defaults, declining asset values, and growing depositor anxiety. No financial institution is entirely immune to the potential fallout. Taking proactive measures now is critical. Visit your bank and consider withdrawing a portion of your savings to hold as cash. Diversify your assets by exploring low-risk investment options, such as treasury bonds or money market funds, to protect your wealth from systemic risks. Keep in mind that even FDIC insurance has its limits, and in the event of a systemic collapse, the government's ability to backstop losses may be stretched thin. Experts warn that the upcoming financial turbulence could surpass the severity of the 2008 Great Recession. The cascading effects of bank failures would not only disrupt personal savings, but could also stifle credit availability, causing severe ripples across industries reliant on loans. From small businesses to construction and real estate, the broader economy would face significant headwinds. In times of uncertainty, knowledge is power. Stay informed about the latest economic developments and remain vigilant about the health of your financial institution. Proactive steps today could mean the difference between preserving your financial stability and being caught unprepared in a crisis. Financial security isn't just about protecting what you have, it's about positioning yourself to thrive, no matter the challenges ahead. Navigating the financial storm together. As we face the possibility of a financial storm, it's crucial to stay informed, proactive, and prepared. The risks to our banking system and personal savings are very real, and ignoring the warning signs could have devastating consequences. However, by taking deliberate steps, such as building a robust cash reserve, diversifying your investments, and staying informed on the latest economic developments, you can protect your financial future and even uncover opportunities to thrive amidst uncertainty. The choices you make today could define your financial stability for years to come. Remaining calm, educated, and strategic is key to navigating this challenging time. Thank you for being a valued part of Economy Explorer. Your support means everything to us as we strive to bring you the most critical and timely updates on the economy. If you found this video helpful, please like, share, and subscribe to our channel to stay informed. Don't forget to check out one of the suggested videos on your screen. It could provide even more insights to help you secure your financial future. Together, we can navigate these challenges and emerge stronger than ever.